Okay. Well, hello, everyone. Good morning. My name is Rob Wojtasek. For those of you who I have not had the opportunity to meet to this point, I had the pleasure of leading our investment advisory services department, and I can't tell you how excited John, Cameron, and myself are to be with you again here this morning and have the opportunity to hold this quarter's investment management webinar. This is the third webinar we've had the opportunity to hold here this year, and we look forward to forthcoming webinars again on a quarterly basis as we go into 2022. If you've joined us before, we hope you're finding these to be beneficial. And if it's your first time, welcome. We hope to see you into the future. I referenced them already, but with me today, navigating us through these discussions would be our lead investment consultant, Cameron Chahaki, who isn't able to join us via video just based on his schedule, as well as John Townsend. And John's going to be with us here on the front end of the conversation, but then he too has a client meeting that he needs to get to. So it's that time of the year for everyone, I suppose. I did reference this, but this is a recorded session. You have been placed on mute, but don't let that fool you. We want to hear from you. So please let us know if there is a question that comes to mind. I'm going to just scroll ahead here a couple slides to give everyone an idea for that chat functionality. I think this slide does a pretty good job on how that works and where to locate that on the webinar. I would ask that if you do have a question, when you go down to select that chat button, you hit this caret here and you send that chat directly to me. So you can do that by simply selecting the host, and then I'll see your question. What we'll plan to do is address as many questions as we can at the end of our time together. We'll have ample time for a Q&A. In the case we're unable to get to your specific question, please know that we'll send out a recording of today's presentation, and we'll accompany any questions and the corresponding answers at that time. So aside, of course, from our introduction here this morning and that Q&A at the end, we've got roughly 20 minutes of content to share with you. This will begin with that overview of the market from John here in a moment, where we've been and where we're going, before going to Cameron to go through the investment management report and any potential funds in question. Assuming all that sounds good, John, if you would, please take us away.
All right, thanks, Rob. If we can flip to page 3 of the market update. There we go. I want to welcome everybody too, and thank you for carving some time out of your day for being on this call and being present. We are intent on letting you know, like Rob said, where we see things as they sit right now and where we see things possibly going down the road. So we start out our report this quarter kind of outlining just what happened, and as we've reopened the economy, we had good GDP growth. The third quarter numbers came in a little bit below the second quarter, which were just north of 2%. Not unexpected. We're still moving towards this normalization, but we've had some headwinds as supply chain issues and inflation fears have kind of dampened the recovery. Make no mistake, we feel that the recovery is still firmly in place, moving from early stages to kind of middle stages, but the concern of labor shortages, higher wages, people not willing to go back to work, people that are afraid yet to go back to work, have been headwinds for economic growth, and not just in this country, but in Europe and China as well. Compounding the problems in Europe and China have been an energy crisis, and we're seeing that spilling over into our economy as well, and natural gas prices and higher natural gas prices going forward. And so, that inflation number of 5% for the second quarter has tapered, but still is higher than the Fed's 2% target. And that is a concern for our team and looking at where we see things going in the future. If you want to flip to the next page, Rob, we do point out here that it was a difficult quarter for global equities, not just in the stocks, not just in this country, but worldwide. The S&P 500 was up a mere 0.6%, which, given numbers, our year-to-date numbers and numbers that we've seen posted in the previous 2 quarters, very slim margins, and not to be unexpected. The economy, as I said, is transitioning from that early cycle to mid-cycle, and we've seen corporate earnings start to slow a little bit for a number of reasons. Higher wages, again, higher expenses, interest rates are poised to go up. Sales are lagging because of distribution and supply issues. I am actually sitting in the office of a client that provides containers and does container shipping, and the cost of a container for shipping goods from China has gone from $2,000 to $23,000. So that's passed along to the consumer, and it's been a headwind for economic growth. We did see the financials recover last quarter, and the industrials suffered because of supply and logistics issues. And we're seeing China struggle. The Chinese index stock market dropped 18% last quarter. They are experiencing much slower growth, and that's affecting their industrial and material sectors as well. Falling rates in the first half of the year have had a negative effect on the Chinese economy as well. Because of the supply chain issues and logistics issues, commodities were our best performing sector for the quarter. Mainly natural gas prices, energy prices have been rising, and the Bloomberg Commodity Index was up 6.5% for the quarter. And it's concerning that we're not seeing any kind of easing yet in the pricing or in the supply chain or labor markets. On the next page, we talk about the Federal Reserve, and as we outlined, as Cam outlined in our meeting last quarter, the Federal Reserve did throw a gut punch into the value stocks in May of this year, when they adopted a more hawkish stance. And we had seen for the first half of the year, value stocks had begun to outperform growth stocks, and with the abrupt change in the Fed stance, that rally not only faltered but it reversed, and money flowed back into growth stocks. We are seeing signals that our expectation is that we'll see rate hikes as early as next year. As we've looked at the projections of the members of the Federal Open Market Committee, that time frame has condensed, and because we've hit the Fed's inflation target and unemployment targets, we expect that we will see rate hikes in the near future, probably in 2022. The Fed's in a difficult spot. Do they raise rates enough to control inflation, bring it down from that 5% that was reported in the third quarter, or do they maintain easy money and try to stimulate growth? So it's going to be a very delicate balance that the Federal Reserve has to affect in going forward to try and continue growth, but not reinflate or create stagflation by stopping growth, by discontinuing some of the incentives that the tapering has created. So where do we think things are going? On the next page, Rob, the Delta variant seems to be fading. We look for the global economy to continue to reopen, which means that some of the inflationary and margin pressures hopefully will subside. We believe that the Fed will continue to taper, and there will be less liquidity and less stimulus. So that will be a headwind for the markets. We think that there is a growing risk that the temporary inflation could get ingrained in the economy, and so again, the Fed has a delicate balance to try and manage that. We expect that equities will still outperform, or domestic equities will still outperform foreign equities, but corporate margins, profit margins are going to be under pressure, and so kind of a repeated theme that we've seen is some of the things that were headwind or tailwinds for the markets for the last several years, taxes, inflation, Fed action, are now going to be headwinds for the markets as we see higher taxes, higher wages, supply shortages, and a tightening of Federal Reserve stimulus will be a headwind for the markets and are of concern. So I would encourage you to look at the two charts at the top of this page. I think are very telling, and both deal with our current valuations of the markets. And you see that in the top left-hand corner, our valuations are very, very close to where they were in the tech bubble in 2000. And I know these are difficult to see, but it's concerning that we're at a point where something's got to give. Corporate earnings need to go up, or stock prices need to go down. That chart right to the right of that shows that the gap between the forward-looking earnings and the index has narrowed, and again, it's concerning that we're back at 2000 levels. So we think that the possibility of a correction is very, very real, and might not. It wouldn't be unhealthy for the economy. But and Rob, so I've kind of reached the end of my time, and if there's any questions that anyone's got for our team, happy to field those. Otherwise, I will turn things back to you.
Great. Thanks, John. Appreciate that commentary. I know you've got to keep moving, so thank you for the time. And at this point, we'll go to Cam unless there's any specific questions, and I'll take a peek at the chat here. It doesn't look like we do at this point, John. So thanks again. And Cam, if you want to take it from here, and the quarterly monitoring report.
All right. Thank
Sounds
you, everyone.
good. Thanks, John. Thanks, Rob. If we could go to the style diversification. There you are. All right, I highlighted throughout the remainder of the report some different things I wanted to comment on, and they're mostly quick points, but there are quite a few of them. So I'll start now and move quickly. The Vanguard Equity Income Fund, nothing unique about it, although I did highlight the zeros, because in your report, you won't see zeros, you'll see a percentage of plan assets that's specific to your plan. But in this report, it is going to say zero because it is not plan specific. On the bottom left, you see Dfa Emerging Markets. I guess it looks orange, but if it wasn't highlighted, it would look red. And red means that it's on the watch list, and I will spend some time covering that fund. If we could go to the next slide, please. Vanguard Target Retirement 2015 Fund. So per Vanguard's system, they've got 7 years post-retirement date before they merge into the income fund. So that's going to be next year in 2022. The 2015 fund will go away. It'll be done becoming more conservative, and so it will have the same 30% equity, 70% bond allocation as the income fund. And there's at that point no reason to have both. Again, the 15 will just merge into income. Next slide, please. Great. So the monitoring methodology, these are our objective screens so that we can have a process that's well documented, repeatable, makes sense. I've highlighted the 3 columns, the criteria. So we are looking at, on this page, we're addressing stock market funds and allocation funds. And we're looking at return over a couple different periods, volatility as standard deviation, Sharpe is a risk-adjusted return metric. R squared is a correlation metric. Manager tenure is what it sounds like, and expense is what it sounds like. With any one of those criteria, we're comparing a fund to its Morningstar category or peer group. And so in the center column, you can see that we're looking at thresholds. So in a lot of cases, we're saying, if you're a large cap growth fund, you ought to have done better than at least half of the other large cap growth funds out in the market, investable, available. And then the weightings, to break that down, it's enough just to say that if you fail 3 or more of the individual criterion, then you are automatically on a watch list. A watch list doesn't mean a fund will be replaced. It does mean quite a bit more due diligence. Go to the next slide. We'll see the index fund criteria. It looks different. It is different. Index funds ought to track the market that they're mandated for, and that's really it. We don't need to know if they did better or not than actively managed funds, at least not for these screens. And then on the next slide, we've got the bond fund criteria. And really the only difference from the bond funds to the stock funds is this duration metric, which bond funds use instead of the correlation metric that we saw in the first set of criteria. If we go to the next, thank you. Target retirement 2015. So talking about this fund again, you see the 83 and the 80 highlighted in parentheses. Those are percentile rankings. So they run 1 to 100. 1 through 50 is the better half. 51 through 100 is the underperforming half. So it looks like the fund's underperforming by quite a bit. The total return numbers aren't all that different, but the primary reason is because the fund is slightly less equity exposure than the comparison group, and stocks have done pretty darn well. And another reason is that on the bond side, the fund is investment grade only. There is no high yield fixed income in the portfolio, and high yield as an asset class tracks 2 equities. So if stocks are up, expect high yield to be up, and by not having exposure there, it means less of credit risk, and maybe less volatility, but it also means that the fund may trail on the upside at times. We're not at all concerned about it. We understand what's going on, and we can live with it. The 2060 fund is showing a failing metric for the 5-year return, and it's, gosh, awfully close to passing. But if there's a primary reason that it's not, it's because the Vanguard products, target date products, have more of a global market cap orientation, meaning that they tend to have more invested internationally than what they're being compared to, and domestic equities have outperformed to an extent that it has caused a very slight underperformance, relative underperformance for this fund. If we go to the next page, the 2065 fund, what I just said about the 2060 fund's 5-year applies to the 65 fund's 3-year, and then the 5-year, it's not 5 years old yet, so it automatically, more or less fails that metric for lack of data. T. Rowe Price blue chip growth, very slight, modest failings. Not a concern of ours. It is a blue chip fund, so it's going to, on the growth side, so it's going to tend to have quite a bit invested in the Facebook, Apple, Amazon, Netflix Google, Microsoft, those sort of companies. And you know, it's rise or fall is very much tied to that. Over time, the fund's been great. They are going through a manager transition. T. Rowe Price is generally very thoughtful, and they make these transitions last 2 or more years. So we're going to keep our eye on it, but you know, that's just a news item at this point. DFA US targeted value is showing a standard deviation that is outside of the passing threshold, and it's very common for DFA funds to have a little bit more volatility than the comparison group. It's because they target lower valuations and relatively smaller companies within any given category. So it's, you know, it's an aggressive approach, which isn't a bad thing as long as we're compensated with better than average returns, which we are. We go to the next slide. We can address DFA emerging markets. So I guess the first thing I'll say is that emerging markets can be an expensive category for mutual funds. However, this fund at 0.35% or 35 basis points, very reasonable, very competitive cost. We like that. But we do have some failing metrics. They're not terribly far off, but this is the third quarter that the fund has been on the watch list. And usually around the fourth quarter is when we start to not necessarily replace a fund, but get a little bit less confident, a little bit less conviction. We might start looking at other alternatives, which we already start to do. You know, none of these things are ever really a fire drill because we see it unfold over a reasonable period of time. But at this point, we're not yet taking the fund out of the plan. They, for a while, had some underperformance because their China exposure was limited by a self-mandated country cap of 17.5%. They took that cap off. So now they have between 30 and 40% invested in China, which is in line with the index and other funds in the emerging market space. And the year-to-date return is 1.2% ahead of the category. So, you know, with that country cap removal, with the, you know, it is encouraging that they've had recent outperformance, which is why we are going to continue watching. It very well could make a fourth quarter in a row on the watch list, but if things are still moving in the positive direction, then we may be able to ride it out. And if we aren't able to, then, you know, we will have a very good alternative that we'll talk about in a future meeting. And I think the last thing I want to talk about, Rob, if you go to slide, one more, please. There we go. So this slide and the next slide will show in the 1-year return column that the target date funds have quite a bit of underperformance. So granted, 1 year isn't very long, and there really aren't any funds in whatsoever on Earth that never have a 1-year period of underperformance. The primary reason, though, for these funds is that what I talked about, that they don't have the high yield bond exposure on the bond side, and that they do have a more of an international orientation on the stock side. Has that hurt them over 3, 5, 10 years overall? Really not so much, but that is a definite dynamic that we see in the 1 year, and just wanted to address that, but, you know, let you know how we see it. Rob, I think it's 25 after. If there are any questions for my material, I'd love to address them. Otherwise,
yeah, let me take a peek here, Cam. It appears we do have a couple minutes, so let's check the chat. We do have one question sitting in the queue. We'll see if any others come in. And Cam, it's a good one. So why doesn't the investment menu include funds in the mid-cap value and mid-cap growth categories?
That is a great question. Rob, would you be willing to go to the first page of the style diversification?
You bet.
Just so we can get eyes on what we're talking about here. So we're talking about the top tic-tac-toe box chart, domestic equity. And on the left side, you see LCM, CSC. That's large cap, mid cap, small cap. Across the top, value, blend, growth. Those are our styles. And we've got, so the way that we approach this, these are all US equity funds. And so first off, you can see that there are already 7 of them. It's quite a few different options for investing in US stocks. There are different types of stocks, but we don't want to have overkill. You know, we think about the JAM study and about the too many choices makes it hard to make one. And so, you know, with that thinking, we looked at, you know, how can we construct this? And what we did is we put index funds in the middle, in the blend, so you can get the entire small cap market at a low cost, or the entire mid cap, and so on. And then we looked at actively managed funds and said, you know what, when it comes to investing geared towards a style, whether it be value or growth, active managers a lot of times can really show their utility. And so we've got large cap value and large cap growth. Those are kind of staples in retirement plans. And then we say, you know what, we'll do small cap value and small cap growth as well. And the reason being is because the large cap funds are going to go fishing in the mid cap pond because they see opportunities that they believe will grow into large caps. The small cap managers, they're already fishing in the small cap pond, but they're going to catch some fish that grow larger. And they're not going to want to sell right away because they continue to think that that's a good stock to own. And so you have a lot of coverage on the active side in the mid-cap value and growth space. In addition, the Vanguard mid-cap index in the blend space actually covers the entire spectrum from left to right, value, blend, growth on that chart. So those are all the various reasons why we have we call it an I formation because it sort of makes a capital I if you can use your imagination. But that's why we don't have mid value or mid growth in the lineup.
That's helpful, Cam. Appreciate it. I don't see any other questions at this time. We're coming up against 10:30 Central Time, so we hope that everyone that was able to attend today came out with a greater understanding of market conditions, not only currently, but here as we go forward into the new year. And we also hope that you came out of here with some additional reassurances on your investment lineup. Again, we'll be holding this webinar on a quarterly basis. Hopefully it's been helpful and that you don't have to mark your calendar unless you wish. We'll continue to send out those reoccurring ongoing invites on a quarterly basis 2 weeks before the actual webinar date. Again, we'll send out the Q&A here that we just went through along with the recording of our time together here in the coming days. But should you have any immediate questions, please don't hesitate to reach out to your Alerus representative. Otherwise, we thank you for your business. Your partnership is valued, and we hope you enjoy the remainder of your day. Thanks so much.